This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast.
Hello, and welcome to The Deep Dive. Today, we're cutting straight to the chase on a topic that's, absolutely central for anyone navigating private equity here in Luxembourg: interim dividend distributions. Yeah, how critical it is to get capital back to investors efficiently, securely. Annual dividends, sure, they're standard. But these distributions during the year, that's a whole different ballgame.
It really is a much more dynamic tool.
Exactly. For active management, signaling financial health. It's key for investor relations. But, and it's a big but, getting it right involves some serious legal and procedural hurdles.
Oh, absolutely.
For corporate counsel, mastering this, it's not just ticking boxes, it's showing real strategic value, operational know-how, and frankly, careful risk management. That's spot on. And our mission today really is to break down that entire life cycle. We'll look at the legal foundations, then the practical steps, the negotiation points and shareholder agreements.
Right.
And crucially, the real cost if you slip up. We want to give you an original sort of curated analysis that you can actually use.
Okay, perfect. And to make sure you really grab the essentials, we've boiled it down to 3 key takeaways. These are the things to hold on to. First, the procedural imperative. There's a strict sequence of legal steps, no skipping allowed. And that 2-month decision window after the interim accounts, it's tight, miss it, and management could be personally on the hook.
Big time.
Second, the auditor as gatekeeper. If you've got a statutory auditor, a reviseur d'entreprise agréé, or a commissaire appointed, their report isn't optional. It's a mandatory safeguard.
Think of them as a co-pilot, legally speaking. Their sign-off is vital if they're on board.
Exactly. No report when needed. The whole thing's invalid. And third, strategic documentation as a shield. That interim financial statement. It's not just numbers.
No, it's your proof.
It's your primary evidence of solvency. For counsel, ensuring that's solid, especially if you're looking at things like dividend recaps, is absolutely crucial risk mitigation. Protects against future claims.
Definitely. It shores up your defense.
So we've set the scene. We know why it matters. Let's start peeling back those layers. Where does the law actually lay this all out?
Right. So the foundation for all corporate distributions in Luxembourg, it's the law of August 10th, 1915 on commercial companies. We just call it the 1915 law.
The cornerstone, really.
It is. And while it's old, it got a pretty major update back in 2016 to, keep pace with modern business.
Yeah, that was a key modernization. And what's interesting is how the law specifically deals with interim dividends. It doesn't matter if you're an SO, that's a Société Anonyme, or an SARL, a Société à Responsabilité Limitée.
The private limited company, yeah. Exactly. The rules are basically harmonized now. They're laid out in 2 articles, 461.3 for the SA and 710.25 for the SARL. And they're almost identical thanks to that 2016 reform.
So it brought the SARL rules up to speed, essentially.
Pretty much. It codified best practices for the SARL, aligning it with the SA, which made things clearer across the board.
Okay, here's where it gets really interesting and maybe a bit nerve-wracking. You mentioned this unbreakable procedural chain.
That's the crucial concept.
So every single step has to be followed. No shortcuts.
None. Each one is a mandatory condition. If you fail at any point, any single point, it doesn't just cause a hiccup. It legally invalidates the entire distribution.
Wow.
And as you said, that's when personal liability for the directors or managers really comes into play. It's serious stuff.
Okay, walk us through those steps then. What are these mandatory conditions?
Right. There are 6 of them. You have to tick every box. First, authorization in the Articles of Association. This is fundamental.
The company's constitution, basically.
Exactly. The power to pay interim dividends isn't automatic for the board or managers. Shareholders must explicitly give them that power in the articles. No clause, no interim dividend. Simple as that.
Got it. Step 1, check the articles. What's next?
Second, the interim financial statement. This is your cornerstone document. It's essentially a balance sheet prepared by management.
Showing the current picture.
Precisely. It proves there are enough distributable funds. It protects shareholders, yes, but also creditors. And the law is strict here. It cannot be dated more than 2 months before the board actually decides to distribute.
So it has to be fresh data.
Absolutely.
Wow.
Keeps the decision grounded in current reality. Third, calculating the distributable amount. The law gives you a very specific formula.
To stop companies paying out capital.
You got it.
Uh,
Prevents capital erosion.
Yeah.
It's basically profits made since the last approved accounts, plus profits carried forward, plus available reserves.
Okay.
Minus any losses carried forward and sums you have to put into legal or statutory reserves. The point is, you can only distribute genuine profits, not the underlying capital.
Makes sense. Protect the core. What's number 4?
Fourth, the capital safeguard. This is like the ultimate backstop. Article 461 to Order 2 of the 1915 law is crystal clear. No distribution if the company's net assets are, or would become because of the dividend, less than the subscribed capital, plus any reserves you can't distribute by law or the articles.
The absolute solvency test.
That's a good way to put it. Ensures creditors are always protected. Fifth, the auditor's report. The mandatory checkpoint. Now, this one trips people up sometimes.
So,
The law says if a commissaire or réviseur d'entreprise agréé has been appointed and, importantly, is registered as such on the company's file at the RCS, the trade and companies register their report is mandatory.
so it's not about whether the company needs an audit generally.
Exactly. It's about whether an auditor has actually been appointed for whatever reason. That appointment triggers the need for their specific verification report for the interim dividend. They check that the legal conditions we're discussing have been met. It's an independent check.
Right, so check the RCS register for an appointed auditor. Crucial point. And the last step.
Finally, number 6, the board or manager's decision. This is a formal act. The board or managers pass a resolution to approve and declare the dividend. And critically, this must happen within that strict 2-month window after the date on the interim financial statement.
Back to that tight deadline.
It ties it all together. Miss that window, and you have to start the process over with new accounts. It really tests the team's coordination.
Okay, so that's the legal framework, the must-dos. But translating that into practice, from the boardroom decision to money actually hitting bank accounts, what does that look like? How do you execute flawlessly?
It's definitely a team effort. Think of it like a well-rehearsed play.
Who are the main actors?
Good question. First, you have the board of directors or managers. They're the decision makers, the ones carrying the primary legal responsibility. Then, the corporate counsel. You're the orchestrator.
Making sure it all lines up legally.
Exactly. Ensuring compliance, drafting the docs, coordinating everyone, building that defensible paper trail. Then, the accounting and finance team, they prepare those crucial interim statements. Promptly and accurately.
Yeah.
If appointed, the auditor, the réviseur, or commissaire acts as that independent verifier. And don't forget tax advisors. They're vital for handling the withholding tax aspects correctly. Legal pros are really the linchpins holding it all together.
Got it. So a collaborative effort.
Yeah.
What about the paper trail itself? What documents are absolutely essential?
Right. Documentation is your shield. You need board or managerial resolutions. These have to be precise. Reference the interim accounts date, show the calculation, confirm all legal conditions are met, acknowledge the auditor's report if there was one.
Meticulous is the word.
Definitely. Then the interim financial statements themselves. Even if not fully audited by law, they need to be prepared carefully to give a true and fair view. The whole decision hinges on them.
Makes sense.
If an auditor was involved, their auditor's report or certificate is key, that specific confirmation they provide. And finally, tax filings. After you pay the dividend, you must file the withholding tax return that's Model 900F with the ACD, the Luxembourg Inland Revenue, and pay the tax.
Okay, let's talk timeline. That 2-month window sounds intense. How does it typically play out?
It is intense. It requires real discipline. So picture this.
The board decides, okay, let's explore an interim dividend, and tells the finance team to prepare interim accounts for, say, June 30th, 2025.
Right, setting the date.
Weeks 1 to 4. Accounting gets busy preparing those accounts. Simultaneously, counsel gets in touch with the auditor if one's appointed.
Lining things up.
Week 5, auditor gets the accounts and does their verification work.
Auditor issues the report back to the board.
Okay, clock's ticking.
Exactly. Weeks 6 to 8, the critical window. Counsel gets the board meeting scheduled. The board reviews the accounts, reviews the auditor's report, confirms everything's in order, and passes the resolution to distribute. This absolutely has to happen before August 31st in our example, within 2 months of June 30th.
The deadline.
Week 9, dividend gets paid out physically.
Done.
Not quite, with 8 days of that payment. That withholding tax return, Model 900F, must be filed with the ACD and the tax paid. 8 days, it's super short.
Wow, okay. So the coordination needs to be spot on right to the very end.
Absolutely. Legal, finance, payments, everyone needs to be perfectly synchronized.
So we've nailed down let's say, the rigid legal rules and the operational dance. But for corporate counsel, particularly in PE, just following rules isn't the whole game, is it?
Right.
How does this become strategic?
That's a great point. In private equity, the 1915 law is really just the baseline, the minimum standard.
The real rules are in the deal docs.
Precisely. The shareholder agreement, the SHA, or in a fund context, the limited partnership agreement, the LPA, that's where the real governance of distributions lies.
So the law says how, but the SHA or LPA says if and when and how much.
Exactly. They're the commercial heart. Counsel's job number one is ensuring the company's articles, which need that board authorization we talked about, perfectly match the SHA or LPA. Any conflict spells trouble disputes, unenforceable clauses.
And often these agreements are tougher than the law.
Very often.
Yeah.
They might demand higher solvency ratios, specific investor consents. It creates this dual-track compliance challenge. You have to satisfy both the law and the contract.
Right. And you mentioned the distribution waterfall and funds. How do interim dividends fit into that?
Yeah, the waterfall is key. It's the contractual cascade, who gets paid what and when from any distributions. An interim dividend is just cash flowing into the top of that cascade.
Right.
You need to understand the model. Is it European or whole fund, generally better for LPs, requiring full capital return before the GP gets performance fees? Or American, deal by deal, where the GP can get carried interest earlier from successful deals?
And interim dividends can trigger that carried interest.
Potentially, yes. And that brings up a crucial point. The decision to pay an interim dividend isn't purely financial or legal. It's often, well, a bit political within the fund.
How so?
It can signal success, boost interim IRR figures for the GP, but especially with an American waterfall, if you pay a dividend that triggers GP carry before the whole fund looks like a success, that can cause real tension between the GP and the LPs.
Ah, right. Balancing interests.
Exactly. So counsel advises not just on the legal mechanics, but on whether the timing and amount align with the spirit of the LPA, maintaining those crucial investor relationships. It's a blend of legal precision and commercial awareness.
Okay, makes sense. Now, every strategic move has a cost. What are we looking at financially when undertaking an interim dividend?
Right. Costs. You've got a couple of buckets. There are direct administrative costs, mainly filing fees with the Luxembourg business registers, the LBR.
Usually modest.
Typically, yes, for standard filings. However, there's a really important recent change. Starting March 2025, there's a new, much stricter penalty regime for late filings.
Ah, okay. What does that look like?
It escalates. If you're late filing corporate acts or info, slipping into the second month costs €50. 3 to 4 months late, €200. More than 4 months, €500.
So procrastination just got expensive.
Significantly, it turns what used to be maybe a minor admin oversight into a real financial risk, makes diligent tracking essential.
Good to know. What about professional fees?
That's the other main cost area. Complexity drives the price here. Legal fees can range, might be fixed for a routine distribution, but hourly if it's complex, like negotiating a new SHA's distribution clause or handling a dividend in a tricky financial situation.
An account?
Accounting fees for preparing those interim statements. And, if applicable, audit fees for the auditor-specific verification report. Remember, that's separate from the main annual audit fee.
So several moving parts cost-wise. How does in-house counsel manage this effectively?
It's about efficiency and perspective. Smart teams create smooth, repeatable internal processes for the routine stuff. And they frame the cost of good legal and audit advice not as an expense, but as an investment.
An investment in what?
In risk mitigation, avoiding director liability, heading off shareholder fights, dodging those new late filing penalties. It's about protecting value.
Okay. So beyond just knowing the rules and managing costs, how does a corporate counsel really demonstrate exceptional value in this specific area? What sets them apart?
It's about moving beyond just execution and becoming truly strategic.
How so?
First, proactive risk management. You are the board's primary shield. Flawless execution, perfect documentation that protects them from personal liability. And think about dividend recaps.
Where debt is used to fund a big dividend.
Exactly. That documented proof of solvency at the time of distribution. It's your critical defense if someone later claims it was a fraudulent transfer. You're protecting the corporate veil, shielding the fund and managers.
That's huge. What else?
Second, driving efficiency and reputation. Getting distributions done right compliantly, on time, predictably, isn't just good housekeeping. It builds the PE firm's brand. LPs value that professionalism and reliability. It becomes a reputational asset.
Makes sense. Operational excellence matters.
Absolutely. Third, becoming an architect of repatriation strategy. A top counsel knows interim dividends are just one option.
What are the others?
Things like share premium reimbursements, capital reductions, even partial liquidations, often using those alphabet shares with different rights. The best counsel advises on the most tax-efficient, legally sound method for this specific situation. It's tailored advice.
So, seeing the bigger picture.
Exactly. Combining the technical know-how with that strategic overview, that's what turns compliance from feeling like a burden into a real competitive edge.
Great points. Finally, then, looking ahead, a top counsel anticipates change. What's on the horizon? What legislative or regulatory shifts should listeners be tracking?
Good question. The landscape is always evolving. A few key things stand out recently.
Okay.
First, the 2025 tax law. It's significant. There's the corporate income tax rate cut to 16% for larger companies, which is noteworthy, but more strategically.
Yes.
There's a new option. Companies can now choose to waive the participation exemption on dividends if they qualify for the exemption based on the acquisition price threshold that's 1.2 million euros.
Why would they waive an exemption?
Flexibility. It lets them recognize taxable income. Maybe they have tax losses they want to use up. Instead of getting the dividend tax-free, they take the income hit but offset it with losses. It adds a new strategic decision point each year.
Interesting. Requires careful analysis with tax advisors, I imagine.
Definitely. Second, clarification on partial liquidations. That same 2025 law clarifies when repurchasing and canceling a whole class of shares counts as a tax-exempt partial liquidation. This gives more legal certainty if you're using alphabet shares for repatriation.
More certainty is always good. Anything else?
Well, there was also a legislative maintenance law in 2023. It cleaned up some inconsistencies from the big 2016 company law reform. Didn't fundamentally change interim dividends, but it shows Luxembourg is committed to keeping the framework clear.
So ongoing refinement and broader regulatory trends. Anything from the CSSF impacting this?
No specific CSSF circulars lately that directly change the interim dividend mechanics for standard companies. But the overall trend, especially post-AIFMD2, is definitely towards tighter scrutiny on governance, liquidity management, risk controls, and funds generally.
So the context reinforces the need for rigor.
Exactly. It all points back to the importance of that procedural discipline we've been talking about.
Okay, fantastic overview. To bring it all home, let's just quickly hit those three key takeaways one last time. First, the procedural imperative. Remember that strict sequence, that 2-month window. Get it wrong, and management faces personal liability. It's non-negotiable.
Absolutely. And second, the auditor is gatekeeper. If one's appointed, their verification report is essential. Don't overlook that check.
And finally, strategic documentation as a shield. That interim financial statement is your core proof of solvency. Hugely important for mitigating risk, especially in PE deals. So thinking beyond just the mechanics. Maybe the real takeaway is that mastering interim dividends isn't just about following rules today. It's about adapting to new laws, new interpretations, and really partnering legal expertise with business goals. That's how you turn complex regulations into, well, an advantage for agility and keeping investors confident. Something to ponder. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.